Chief Market Analyst here at ITM Trading, a full-service gold and silver dealer specializing in custom strategies to help you survive and thrive the crisis that frankly has already begun. And today we're going to talk a little bit about real estate among other things, because we just did a video recently on muni bonds, and then lo and behold, America's housing crunch is so bad it may hurt city bond ratings. Why? Because the affordability factor for these homes is also out of control. It's way beyond anything that the average person can afford, which means that they move or they downgrade, and that hurts income for the municipalities, the states that are issuing these bonds. You know, incomes have not kept pace with the increase in real estate and housing, and cities count on that and states count on that to generate their income. In fact, you know who recently counted on it a lot? Washington, D.C. And they joined the muni selling spree with record bond deals. Actually, what they're talking about here is that there has been, the nation's capital plans to sell about $1 billion of bonds to refinance, mind you, this is not new, this is refinance the debt they've already issued and pump some money into community revitalizations. It comes amid a flood of activity from municipalities that pushed the amount of bond sales this year up 20%. Okay, so yeah, I mean, cities, counties, they're taking advantage of these low interest rates, but what they're missing is that these bonds, at some point, you're not going to be able to roll it over. And especially when you look at the heavily indebted cities like we have. In addition, the District of Columbia, D.C., well, they used to actually trade at a premium, that's this black line, to AAA 10-year benchmark. But now they trade right with it. So you're not getting paid for the risk. Now, this is the piece that I was talking about that I find really, really interesting. I am intending to do a lot more research on this. I pulled up some government reports. I haven't had a chance to do that yet. But I wanted to bring this to your attention. Okay, you have two kinds of mortgages: recourse mortgages and non-recourse mortgages. In a recourse mortgage, let's say you take out a $300,000 mortgage and then you default on that, and the bank takes your house back and they can only sell it for $250,000. In a recourse mortgage, you would be responsible for that other $50,000, so they can attach your paycheck or other assets, etc. With a non-recourse mortgage, then you walk away from the house and then they have to eat that other $50,000 as a loss. Well, in this court case, it's really interesting. City Mortgage had purchased a bunch of homes from Equity Bank, blah, blah, blah. And 12 out of 12 of those mortgages that are in dispute, 6 of them had already been foreclosed. So they went to court over this. The court ruled that they agreed with Citi. Let's see, in a disagreement, the parties would settle or could write off the loans. Okay. However, there was reason to press on. 6 of the 12 loans had been foreclosed, and Equity Bank made the remarkable argument that foreclosure and resale meant that the mortgage loan no longer existed, meaning that there was nothing to repurchase as they had promised. They had a recourse. They had a recourse agreement with Citi Mortgage. Okay, the bank ruled in their favor, and part of the ruling relied on the language of the contract, but the court's interpretation of the language assumed that Equity was right, that foreclosure extinguished the loan. In other words, was non-recourse when these mortgages or this deal between Equity and Citi were recourse. Citi Mortgage has not explained what exactly Equity was supposed to repurchase without evidence of what, if anything, remained of the underlying loans. So, in essence, what they actually then said, because this is going to be used as precedence, I'm sure they're going to go back into court, but basically this ruling establishes precedence for all mortgages to be non-recourse. Now think back to 2008 and all of those mortgage holders that defaulted on their loans and had their houses foreclosed, they walked away. And of course, the banks were made more than whole and compensated, but basically the homeowner was able to walk away. I gave you a list here so you can go into the blog and see it of all of the states that are non-recourse states, so they can't even write other kinds of mortgages in there. But that is a game changer potentially. So we have to keep our eyes on that and see exactly what happens with it, and I will be doing a more thorough report on that in the future. Now, the reason why I'm bringing up WeWork in here is because they just posted their losses, and thank goodness. I mean, do you guys realize that if they had brought WeWork public either in December or January or something, or November, that they probably would have had somewhere in the realm of a $48 billion valuation. But recently they actually were bailed out by SoftBank, who has a huge stake in them, to prevent them from going under. I don't know whether or not that's going to be true, because their occupancy rates have dropped, their losses have grown, and they're sitting on less cash, even with that recent cash infusion. The reason why this matters so much is because WeWork has gone in and bought up commercial, a tremendous amount of commercial real estate in different cities around the country. And so if they go under, there's going to be a lot of new commercial real estate that is coming onto the market. This is not a good thing. So it isn't just whether or not SoftBank has done it, because WeWork on their own took out a tremendous amount of debt, as have SoftBank, to fund a lot of their unicorns and their spending. So I think that this is a huge crack between what we just looked at and other things on what is actually happening in the real estate market, including this headline: JP Morgan steps on Freddie and Fannie turf, because what they've come up with is a new product called a credit risk transfer. Last month, they became the first U.S. bank to issue credit risk transfer tied to pools of mortgages, because CDOs and mortgage-backed securities and lots of other things were not enough. They have to leverage it even more. The bond-like instruments have been embraced by government-controlled mortgage guarantors Fannie Mae and Freddie Mac since their introduction in 2013. So it takes the place of those CDOs. Investors will shoulder losses up to a certain level if homeowners default on loans in the underlying pool of mortgages. In essence, JP Morgan has bought a type of insurance on loans it has already made to borrowers with higher credit scores, that in turn should allow it to hold less capital against those loans. Now, here's the thing. When we go into a global slowdown, everybody's going to be impacted. So taking into consideration the recourse and non-recourse loans, I'm going to pull all of this together. Bear with me. I'll get that done as soon as I can. But it's really a very big deal. The other thing that I need to talk to you about is what happened when Powell was talking, Fed Chair Powell was talking in front of the Senate Banking Committee. And basically he's saying the new normal is low interest rates, low inflation. And I say that with a little bit of a catch, because, your cost of living is going up. So whatever they want to say. But look at this budget deficit. We're close to $1 trillion now. We're not done with the rest of the year. This is the year end actually for the U.S., but they're pushing interest rates down. Remember, there's that battle that's going on. Markets want to push the interest rates up, but nobody can really afford that. And the government has a very bleak outlook for government debt, because, let's see, this is on a report that Moody's published, said political and geopolitical turbulence is exacerbating a slowdown in the trend GDP growth, and we know globally that's going down. They talk about the emergence of influential populist movements, and we're going to see that very shortly in this country as well. Real quickly, there is a severe pension crisis. We know that. They're expecting 15.8 trillion. I mean, these pensions are in all sorts of illiquid assets. But this is the key, and then I got to close. Why the Fed is losing potency. This is the monetary velocity, the speed at which money changes hands. We saw it turn up a little bit here. It has turned down again. Remember I said, when this starts to go up in a pervasive way, then we will know we have entered hyperinflation. So, and there's only one way to fight deflation, and that is with inflation. So that's it for today. The FedNow payment system launched 4 days ago, and there are major concerns about how this infrastructure could lead to central bank digital currencies and the reset of the US dollar. Your money is becoming less and less safe by the day. One of our clients received a suspicious letter from their bank telling them that there were some exciting changes coming. The letter said most of their account information would stay the same and their online experience would be changing and some account features. I asked to see the prospectus, and after days of digging, I just confirmed that FedNow was behind these changes. And I'll show you how they're doing it without you knowing it. Because I've been saying for years that the shift is going to happen without you knowing, and by the time you know, it'll be too late to do anything about it. This is about how to do your own digging, how to read between the lines, and how to protect your assets from financial manipulation and control. Coming up. I'm Lynette Zang, Chief Market Analyst here at ITM Trading, a full-service physical gold and silver dealer, but specializing in custom strategies. And let me tell you guys, you need to have one, because they have one. They have a plan, and they're executing it, and it involves converting you into their slaves. So fortunately, we had a wonderful client that sent in a letter that he got from its bank, Webster Bank. And it said, okie doke, because really what this is the spider quietly building its web. And let me tell you, before I start this, why this is so important is because this is an absolutely perfect example of how they get you into compliance without you even knowing it. It is perception management at its flippin' finest, and I am so ticked off I can't even stand it. Let me show you what I found. I mean, I was totally I'm just going to go on, okay? Because this impacts everybody. It isn't just Webster Bank that this is happening with. It's everybody as the central bank spiders build their web quietly. So what do they say in this wonderful letter? We are pleased to share that on July 24th, 2023, we will introduce a new operating system and digital platform that will help us bring you important enhancements, for who? Including a new lineup of products and services. Isn't that great? Isn't that just great? So, hey, this is great. They're doing all sorts of new stuff for your benefit. Don't worry, because a personalized account summary that identifies your new Webster deposit accounts that have been carefully selected to bring you product features and benefits comparable to those you already have. They have to keep things as close to what you're used to as possible so that you do not notice that anything has really changed, when in reality, everything has changed. For those of us that are my age, you remember back to August of 1971. And what were we told? Just buy American. Nothing has changed. You're not going to get inflation. It's not a problem. But the reality is after August 1971, everything had changed. Everything. Our updated account disclosures booklet, this is your contract. This is your contract. Effective July 24th, 2023, containing terms and conditions you should review and retain for your records. This is your legally binding contract. If you continue to use the account, you have agreed to these terms. Now, I got to tell you, I went into this and I wanted to know, okay, what's changed? And when I'm reading this, I can't see anything that has changed because they don't want you to understand what has changed. So I went in and, being the little ferret that I am, I started to dig because I realized just reading this was a waste of my time, right? I mean, you are legally bound by this, but it was a waste of my time. I can't wait to show you what I found. Thank you. Thank you so much for that wonderful client that sent this in and brought this to my attention and had me focus on it. I want you to know right now, I really, really appreciate it. Absolutely. And I'm sure everybody watching really appreciates it too. Because what I'm about to show you in black and white with all the links is how central banks and governments change financial regimes without you realizing it. How they get you suckered in, and then it's too late. So let me show you. Now, going on their website, what does it say? What's changing? All right, that's what I wanted to know. I'm sure that's what you wanted to know. But they're going to start with what won't change. So account numbers, check, direct deposit, automated payment, debit card, online mobile use. Nothing really. These are all the services that you're using. Nothing's changing. Notice how nice and long and specific this list of what is not changing is. Specific, right? Let's look at what will change. Two things will change. No big deal, right? Some account features, though they don't say what those are, and your online experience. And again, they don't say what those things are, but what they do is you'll notice two things, so it's much shorter, and they are completely non-specific. And if you want to know for details, please refer to the important topics. So now you've got to do more work. Most people are busy. Most people are going, well, the things that matter to me, those aren't changing. And there's only, some little things that are no big deal. And so you agree to it because you don't know what's going on. Plus, if you want to use your account, I don't know that there's any place you're going to be able to get away from it. I mean, not everybody is adopted, but they will. And I'll get into more about that in just a second. So again, the formula, and they have done this in 1913. They've done it many, many times, but they certainly did it in 1913. They did it in the 1940s at Bretton Woods. They did it in 1971. And I am here to sit here and tell you, and I've been saying this since 2008, no doubt in my mind, the old system died and was put on life support to get all these new things in place. And by the way, things that you used to be able to do with your bank account, like give your kids cash. I mean, when my girls were in college, I would deposit cash into their accounts. Boom, can't do it. That's one little minor thing, and you say, well, that's not a big deal. Nothing in and of itself ever seems to be that big of a deal. But when you step back and you look at this whole spider web, you're getting caught. Let's move forward. Okay. Webster Bank is this was the point that I wanted to make too. Okay. Remember, I've told you over and over and over again, because they've told me in their big documents that the IMF and the BIS and all those guys do, what do they want? They want distance between policy, So they want to institute the Fed now accounts and how it's introduced to you. This is how they're introducing it. So just keep these things in mind. So kind of obscure. Look at this. You are going to have access through your debit cards, which people use, the debit cards, the credit cards, a surcharge-free ATM through MoneyPass. So they're telling you, continue to use your current Webster Visa debit card with your existing PIN to access your account. See, nothing has changed. And starting today or yesterday, you'll gain access to more than 40,000 MoneyPass ATMs across the U.S. with no surcharge fee. See what's changing? That's what's changing. Now, you're going to look at that and go, well, great. Now, that just means that I'll be able to access my cash in 40,000 more places if I need it. Isn't that grand? Well, yes, and many people think so. Today, more than 2,000 organizations and 160 million cardholders rely on the surcharge-free MoneyPass network from FizServ. FizServ. MoneyPass? FizServ. Okay. Who are they? Who's FizServ? Well, I went online, and FizServ has been around for a while, and I thought, well, I think I even made mention that I somehow felt that this change with the timing and everything was about the Fed Now. So look at what you're watching. This is from Fed Now. The links are below. It's 2 pages long. You want to know if you've got, if they're participating in the Fed Now program? Click that link below and check out and see if your bank is on there. Because these are early adopter financial institutions, okay? And there's a whole nother page of them with all of the banks that are participating already and in this rollout. Now, clearly that means that not every bank is, but guess who really are? Oh my goodness, who is that? FizServ Solutions, LLC. FizNow, FizServ Payments Exchange, voila. Okay, there is the connection, buried so that you don't see it. I couldn't find it in here. I mean, FizServ, yeah, but I couldn't find this connection in there. So now, all of those people are connected to the FedNow service through FizServ, not obviously directly through your bank. Though there's a whole list of banks, and again, I'm going to encourage you to click that link and go check it out and see if your bank isn't one of those that are participating as an early adopter. So the reason why you and it's not more blatant, I mean, they came out with the Fed Now, announced it in 2019. Why did they announce it in 2019 when they're only bringing it out in 2023? And what did they say then? Everybody's going to have an account. But you're not going to know it until this next crisis when they dump CBDCs, digital dollars in there. Go shopping, go spending. Don't worry, we're stimulating. And if you're desperate, if you have not become your own central bank, what are you likely to do? And even if you have, if somebody gives you free money, what are you going to do with it? You're probably going to spend it. The question is, and this is the challenge that a lot of the central banks have been having, is whether or not you continue to make deposits in there, so convert your current savings and checking account into this FedNow account after they've tried to get you used to using it. That's where we can have pushback. But I'm telling you right now, you need to become your own central bank so that you are as independent and self-sufficient as possible. I mean, it really is that simple. Just keep things seeming the same so that you think nothing has changed when everything has changed. So for all these guys at Webster Bank or all these other entities that are there and on page 1, which I didn't put up here, but you can go and see, Everything has changed. Does it mean we don't have a choice? No, that's not what it means. It means that we do have a choice because you vote with your wallet and you vote with your purse. This is my vote. Sound money. And food, water, energy, security, barterability, wealth preservation, community, and shelter. That is my vote. That's where I spend my dollars. And obviously, all of this is just funny money. But then again, even I can't call them legitimate because they're a derivative of this. They were designed as a derivative of this so that we did not know that anything had changed when they took us off the gold standard. When in reality, everything had changed. What are you going to do about it? Is this okay with, gold and silver are okay with you, but is this okay with you? Because I got to tell you, it's not okay with me. Can you live without a bank account? Probably not. I mean, a lot of people, you have automatic deposits, automatic withdrawals, blah, blah, blah. This is still our tool of barter. See, I was a little nicer to you this time. So we do have to use it because it's what's recognized. But let me tell you, the confidence is at its lowest level. And when it gets to loss of confidence, a big fat goose egg in confidence, this will mean nothing. They're going to say, don't worry about the CBDCs because there won't be inflation. No, there'll be deflation. We'll be able to control everything. You're going to be just great. Don't believe them. Why would they magically suddenly be doing things in your best interest when they haven't done that since the day you were flippin' born? Central bank's job is not to take care of the public. It's to make sure that they exist. Same reason that governments, that's the same reason for governments. Government's job, look at the job that they've done, is not about you. It is purely about making sure that they remain in control. But we have a choice. There is a revolution that's brewing. No doubt about it. Look at what's happening with the unions coming back. I mean, there are so many parallels between every single monetary shift. That makes it easy to understand what's happening. They're out there on the campaign. No recession. Soft landing. I'm sitting here telling you, garbage, garbage, garbage. Oh, and did I mention this? Garbage. Absolute garbage. Don't believe them. Protect yourself. Protect yourself. Protect your wealth. Keep an account there, but don't keep more in there than you really need. You take out cash right now, that's cash in the wild before they put the chip in it. But just remember, we vote with our wallets, we vote with our purses. This is my vote. And quite honestly, in my opinion, it should be everybody's vote. And if it was everybody's vote, guess what would happen? They would lose control and we'd have a shot at a much more fair system. But what do they prefer to give you? More garbage, garbage, garbage. Gold ETF flows. I mean, really. You don't own gold if you own an ETF. You own a share in a trust of a diminishing asset that was purely designed to mimic the manipulated spot market. That won't protect you. It will not protect you. Wall Street's gold is fool's gold. Don't believe they're garbage. Yeah, look at the stock markets. Because that's what most people pay attention to. You open your 401k statement, and as long as it hasn't dump-a-rooskied, you're like, oh, all right, well, everything must be okay. Because most people aren't paying attention. They are too busy trying to keep everything together, trying to feed their families and save for retirement. You can't save for retirement in this system.
When I first became a stockbroker, nobody ever talked about people outliving their retirement funds because you could get treasury bonds at like 8-9%. So you'd live off the interest and preserve your principal. You couldn't outlive it. Well, guess what? Today they'll tell you, all right, you're going to outlive this if you live past 86 or 72 or 93 or whatever that number that they miscalculate is. But here's the reality: because of what they are doing to this currency, with all of this, just trying to stay in power, that's what this is about. Staying in power. I don't want them to stay in power, do you? Because they aren't doing what is in your best interest, what is in the public's best interest. They are picking and choosing winners. As George Carlin used to say, this is a big club and you ain't in it. Let's create our own club. Let's create our own community. This is my vote. I hold it and I own it outright. That's why the Bank of International Settlements, what gold in reserves. This is real money. This protects you from inflation. Gold held at home does not run geopolitical risk. I'm telling you, guys, this is so simple. You vote with your purse and make sure that you are secure in food, water, energy, security, barterability, wealth preservation, community, and shelter. We are close to the end. They are setting up everything. Stop. If you've been waiting, stop. I mean, it's just so simple. Just stop. Just do something different. If you're holding silver and gold, what's the worst thing that happens? You know, I always like to go, what if you're right? What if you're wrong? What's the worst thing that happens? What if you're wrong? It's used in every single sector of the global economy. When I travel, I always make sure that I have gold with me and some silver. So if you haven't subscribed yet, click that button and subscribe. Start your gold and silver strategy by clicking that Calendly link below and setting up a time, putting your best interest first. That's it, period. This is not rocket science. They're taking you down. If you believe them, there's 3 cents worth of purchasing power left. But in reality, they're going to take all of it because they are greedy SO whatevers. I'll let you fill in the blanks with that. But seriously, I mean, I did a happy dance when I found that connection. Obscure. Unless you're a little ferret. It's there. It's there. You agreed to it. It's there. Your perception means nothing in a court of law. Don't you remember 2008? Who went to jail? Nobody. Why? Because what they did was disgusting, just like what they're doing now. Disgusting, evil, vile, but not illegal. Because who writes all these contracts? That's what Wall Street is about, contracts. I'm about real money and community. Please get it done. Because the reality is, it's not just your financial shield, your freedom, your family's freedom. And you guys know I'm fighting for my grandchildren and my great-great-grandchildren that are not even born yet. Because if we don't make a stand, it's only going to get worse for most people. It's not going to get better. But we have choices, and it's not all doom and gloom. If you make those choices, then you can build a fantastic foundation for you and your family that you cannot outlive. Until next we meet, please become your own central banker and be safe out there. Bye-bye. In the beginning, we had gold and silver money. You didn't need any guarantees because these were the guarantees. Then they transitioned us to this, this is a gold certificate, a $10 gold certificate. So you'd walk in the bank with this and you could walk out like that with that. And so that helped you feel like, okay, well, these had some value until they don't. But what's coming up is about to devastate most people. And the foundation is laid. I'm going to show you this and more coming up. I'm Lynette Zang, Chief Market Analyst at ITM Trading, a full-service physical gold and silver dealer specializing in custom strategies, and you darn well better have one because this is now 2023. And I'm going to talk to you about the insurance and what's really happening underneath the surface that actually puts all of your wealth at risk. And you've heard the term bail-in. Well, back in 1933, what did the government have to do? There was a bank run prior to that, 29. There was a bank run and people actually got very local and were bartering because they did not trust the banking system and the money because of all of the devaluations. Let's just take a little trip down memory lane. So after the stock market crash in 1929, people stopped trusting the banks, the monetary system, certainly the stock market. Their confidence was really lost. And so the government and the central bank, in order to stay under control, well, they had to make some changes. Let's listen to Roosevelt's, an excerpt from Roosevelt's fireside chat.
The new law allows the 12 Federal Reserve banks to issue additional currency on good assets, and thus the banks that reopen will be able to meet every legitimate call. The new currency is being sent out by the Bureau of Engraving and Printing in large volume to every part of the country. It is sound currency because it is backed by actual good assets.
So let's think about what he just said there, right? What he was really talking about is after the confiscation of the gold in 33, those are the good assets that he's referring to. And he's also referring to the revaluation when he was talking about them being able to issue this money in large volumes. So he wanted to prevent the run to continue, much as we saw back in March of 2020 when we had all these central bankers coming out and saying, you don't have to worry about your cash in the bank or your money in the bank because we can just create as much as we want to. So don't worry about it. It's the same kind of rule book that they used to use. And by the way, I'm going to show you this. This is the $10 gold certificate. And you could walk into the bank with this and walk out of the bank with this $10 gold coin. Well, I want you to take a look at the new $10 bills after that. They look very, very similar. So that's the way they make these transitions. They'll change the laws to instill that confidence, and they'll try and keep things looking as close to normal as possible so that you don't realize that anything has changed when in reality, everything had changed. The other thing that they did was install the Glass-Steagall Act, which separated deposit-taking banks from investment risk-taking banks. So they wanted everybody to feel confident because, after all, what created the crash in 29 was a lot of risk-taking. There's more to it, but that's for another day. And they guaranteed deposits. That's when the FDIC was born, so that people would put their deposit in the bank trusting that they would be able to get it back out again. We're going to talk more about that in a while, but I think it's really interesting that openly he was talking about the revaluation of gold to dollars, which enabled them to print so many more because, after all, they're backed by good assets. Guess what, guys? These are still good assets. But this evolution, they can't do things overnight because then you notice things and you make different choices. And I've talked about this many times. In 95, they legalized Reg D, and that actually was about the banks having more money to work with in their speculations, because when you make a deposit in a bank, it is swept into a sub-account that is in the bank's name, not yours. And that's how they justify, or they legalize, the banks using your equity for their benefit. And by the way, what's that called? Deposit reclassification. It's also what sets up the bail-in. So, you may think all of this is just coincidental, but I don't think any of it's coincidental. I think it was very well planned. And what happened back in 99? Financial Services Modernization Act, the Gramm-Leach-Bailey Act, which repealed large parts of the Glass-Steagall Act and allowed deposit-taking banks to merge with Wall Street risk-taking banks. Okay, that was 99, and we certainly know what happened afterwards in 2008. But has that changed? No, it's just gotten bigger and bigger and bigger, all of these risks. We'll talk more in a second. But over time, depositor protections were removed, not a shocker. They did it again in 2008. But this also enabled consolidation of the banking sector. So back between 90 and 96, there were 37 banks down to 4 in this particular example: Citigroup, JP Morgan, Bank of America, and Wells Fargo. Those are the big 4. And you can see how we went from a whole bunch of banks down into 4. So what that really does is it concentrates the wealth and the risk inside the financial system, because if one of these 4 go down, you've heard of the term too big to fail, right? Well, this is 2007 to 2009. The crisis began in 2007. And that consolidation into fewer and fewer banks has continued. This is 2008 to 2019, the most current numbers. And this is Austria, Italy, Spain, Germany, Japan, and the U.S. Here's the U.S. right there, that green line. So that whole trend and of consolidation of risk is happening globally as well. It is not just a U.S. issue, it is a global issue. And what has their access to all of that very cheap depositor money for their speculation? Well, you've seen this about a gazillion times. This goes through the third quarter of 2022. This is the most current data that we have on this. And you can see that derivative exposure was here in 2007 when the crisis began. And it's higher than that. And in the meantime, we've talked about it, they have created these mathematical formulas, netting and compression, to make it look smaller. So do we know how much is really at risk? Well, let's see what the FDIC has to say about that. Because what they say is, while the notional amount is a proxy for the amount of derivatives activity, it does not measure the riskiness of the activity, nor, frankly, the size of the activity. And just keep in mind, they're doing all of this risky behavior with your deposits. Legally. Nobody went to jail in 2008 because it was all legal. So let's take a look at how much is at risk of bail-in. And this is the estimated FDIC insured deposits as of June 2022. This is the most current diff from the most current diff report. I remember, you've got links. You can listen to the whole Fireside Chat. You can follow all these and take a look for yourself at the FDIC's Deposit Insurance Fund diff report. So this is total FDIC insured institutions. There are 4,780 of them, banks and savings and loans.
They have 23.8 trillion in assets, so that includes your deposits. Out of that 23.8, 18.1 trillion are in deposits, but only 9.9 of that 18.1 is insured. The rest of it falls above that $250,000 threshold for the insurance. So how much is it? 8.2 trillion that is not insured. Boom, as we've seen in Greece, in Cyprus, in Portugal, in many other countries around 2013. All the rest of that gets bailed in. So you have to kind of wonder, if you're a small business and you have your payroll in the banks and that beats that $250 trillion or $250,000 insurance limit, is your payroll going to be bailed in when there's a bail-in event? So how much of the 5.7 trillion in other assets could be those speculative derivatives? We already know that banks generate more than 52% or 50% of their income through trading. But let's just take a look at how much is in that fund to protect the other, that, what did I say that was? 9.2 trillion, 9.9 trillion. How much is in there to insure that? Let's take a look. This is the Deposit Insurance Fund balance, also known as the DIF, and these are the insured deposits. So there's your 9.9 trillion. But oh my goodness, they only have 124.458 billion to insure 9.9 trillion. Does that seem about right to you? No, that's 0.0126 pennies for every insured dollar. So that means that as long as only one bank and they go down in an orderly fashion, okay, you're not going to know it. But if there is indeed a real crisis in a lot of those big banks, you saw the 4 big insured banks, they go down at once, you, my friends, will notice, because they're not going to be able to give you that money. And they were one small bank failure away after 2008, 2009, one small bank failure away from the whole world knowing that they were out of money. They're insuring 9.9 trillion. How are they going to do that with 124 billion? They're not. So what all of this is extreme leverage with minuscule reserves, because all of the new laws, way more than what I've talked about, has been all about reducing reserve requirements. And what that means is if the banks don't have to put money here for a rainy day, then they have more money to speculate and play with. And then that means more profits and all sorts of other things. And as long as everything is hunky-dory, you're okay. You're never going to realize the risk you're in. But when things turn different, they turn different. And by the way, they have turned different. The debt bubble has popped. Wall Street's lucrative leverage debt machine is breaking down. They're stuck, and we've talked about this before, with roughly 40 billion of risky debt on their books that they typically repackage and sell to you for your retirement, for your IRAs, etc. And now they're stuck with this debt because frankly, investors are going, no, I'm not really comfortable with this. Yeah, so they haven't been buying it. And I just want to bring this up because we talked about it a couple weeks ago. The $12.6 billion of debt that backed Elon Musk's buyout of Twitter is by far the biggest burden weighing on balance sheet for any single buyout. But what I want to point out to you is that the equity that he used were his shares of stock. That's when he used that as collateral for these loans. And now that stock is down big. Can you see? It's, oh, what a tangled web we weave. Well, first we practice to deceive. This is a very tangled web. But in the same time, so this is their lending machine, the debt machine,
Bank of America reaps benefits of volatility as lending income misses. So traders beat estimates of what they're going to, all of that volatility, that generates the trading revenue. And those traders beat that estimates, not on the debt side, not on the lending side, but on the speculation side. Because investment banking, so we're talking about this kind of banking over here, fell 54%. And don't you think then the banks are going to be more and more dependent on trading revenues, what they can pick up? Fees for advising on mergers and acquisitions declined 43%. The underwriting of equity deals fell 65%. Debt underwriting slumped almost 58%. You see the problem? So they've got to keep this machine going. They've got to keep those profits going. And speculative trading becomes a whole lot more important. But this is what I really want you to hear, because it's not me saying it. This would be, if you only share this slide with your family and friends, they need to hear this. And by the way, the link for this entire, I think, 3.5 hour meeting is below. But you also have just the snippet links as well, because the FDIC bankers discuss bail-ins to deal with impending market collapse.
Accessible when people need to know, but I don't think you have much hope of reaching a public that doesn't have a professional need to know.
Yeah, why do you need to know
I completely
this?
agree with that. I almost think you'd scare the public if you put this out. Like, why are they telling me this? Should I be concerned about my bank? Like, my insurance company doesn't tell me what they're doing with my assets. They just assume they're going to pay my claim, right? I think you've got to think of the unintended consequences of taking a public that has more full faith and confidence in the banking system than maybe people in this room do.
And that's the FDIC.
We want them to have full faith and confidence in the banking system. They know the FDIC insurance is there. They know it works. They put their money in. They're going to get their money out. So there's a select crowd of people that are in the institutional side. And if they want to understand this, they're going to find a way to understand this. There's a bunch of law firms represented in this room. There's a bunch of people who charge them by the hour a lot of money to explain this all to them. And it's fine. I don't have a problem with that. And they all have huge staffs. But I would be careful about the unintended consequences of starting to blast too much of this out in the general public.
Yeah, because they don't want you to know. And just like we saw in Cyprus, and you remember that graph, and maybe, Edgar, we can just kind of post that in there. Your deposits are what they call sticky. Ask yourself, when was the last time you changed banks? People don't. They just trust, okay, I'm going to make my deposit. That's my money. It's not. It's legally their money. It's not your money. You've now loaned them that money. But in your mind, you're thinking, that's my money. And so when this next crisis happens, well, let's see what they say about discussing the bail-in.
Little bit conflicted, right? I mean, it's important that people understand they can be bailed in, but you don't want a huge run on the institution. But they have, I mean, they're going to be. And it could be an early warning signal to the FDIC and the primary regulators when these things happen. And there may be some other prices. This is similar to what Jay was saying in the market, that you can tell whether people understand who's going to be protected, who isn't going to be protected.
You're not going to be
It would
protected.
be, I think, an interesting study to look at the evolution of market prices in a situation like March of 2020, for example, and see whether people understood what might happen. Right?
Yeah, did you think that in March of 2020, were you thinking that your savings might be bailed in? And so what did you do? That's when there was a start of the run going all the way back to the beginning, right? That's when there was a start of the run at the banks. And we had all those central banks trot out and say, oh, but no, we can just print as much money. We can just print as much money as we want. You don't have to worry about your deposits in the bank. You can get your money back. Yeah. Of course, it has a whole lot less value, hello inflation, than when you put it in there. But people will ask me all the time, oh, but what about CDs and what about bonds? Well, okay, let's see what the this FDIC committee says about that.
I think we have to sit down and talk to long-term debt investors and make sure that they, as a stakeholder group, fully understand bank debt today is not what it was before. It is not principal protected by design. And I think that expectation, I like how you started off, Betsy, like it's all about expectation setting. And I think that is absolutely critical. If that doesn't hold, this whole thing doesn't hold. And so I think it's one area to focus on. I do want to go back to something Jay said about stable.
So they know what they're about to do and they're making plans. Are you making plans? Because you need to click that Calendly link below and set up a time to set up your own strategy and become your own central bank, because you cannot count on FDIC insurance. You cannot count on them. And my question is, you've got to ask yourself, is it okay if they take your deposits? Is that okay with you? Now look, we can't just close out our bank accounts, and I'm not telling you to rush and pull every penny out of the bank. If you're running a business like I am, obviously you've got to have money in there to run your business. But anything more than that, why are you leaving it at risk and in jeopardy? They have roughly a penny for every insured deposit. They have a lot of deposits that are not insured. I make sure that I have enough cash outside of the system in a private vault so that if something like that happens, I can still pay everybody that works with me, because I don't want them to be in a bad position. Now, of course, once they take this all digital and we have CBDCs, that makes having this and this outside of the system that much more important, because it is good money, good assets, as Roosevelt says, that will get you through whatever you need to get through, because you can always convert this into the local currency if you need to, or if, like we were in the Depression, we go to bartering because people no longer trust the money, then you've got something to work with, because this has the broadest base of buyer and the broadest base of demand. And it's the only financial asset that runs no political risk and no counterparty risk. And we know that central banks have been binging like crazy on gold. Why? Because you just listened to the whole group over at the FDIC. You think central bankers don't know that better than you and me? Oh, yes, they do. And they also have an indication of just how close we are. And while everybody makes this assumption that they want this thing to keep going forever, I do not make that assumption, because there's virtually no purchasing power left in the currency, and they're anchored somewhere near zero. They're attempting to do a liftoff in interest rates, but that's pushing us into much more than a global recession. Although, if you listen, you're going to hear, oh, this is just going to be a mild recession. No, this is the end of this currency's life cycle. It's the end. It's over. It's over. There's no purchasing power left. They have to attack principal. That is, by the way, what negative rates are. But this is not impacted by it. And who knows more about money than central bankers? And who knows more about what they're doing than central bankers? But also the 1%, right? Look at that, these coins. Now, this is not an ultra rarity. This is a lot more common than that, which is all we need. I just want to be in this category. You don't need to spend $8 million on a coin, but I want to be in this category, because as we're seeing in places like Ghana and India, etc., that gold can easily be, well, not easily, but gold can be confiscated. They don't want you to hold your wealth. But are they going to swap an $8 million coin for $42.22 or even $50, which is the face value of the new 1 ounce gold eagles? No. So I want to be in that category, so it doesn't matter. What if I'm right and they confiscate? What if I'm wrong and they don't confiscate? Doesn't matter. 100 bazillion%, this is the end of this currency's life cycle. And nobody seems to be talking about it but me. I lived through it. I lived through it in 71. I know what that looks like. I want to live through it this time with my wealth protected. Because who knows more about protecting and accumulating wealth than the 1%? I mean, seriously, do you really think that it's just a coincidence that global central banks and the 1% are accumulating gold as fast as they can at the same time? I don't think it's a coincidence. And I think this is what you should do too. It's what I'm doing. So we started doing something for just this minute because it is so important for you to understand that the system actually died in 2008. And so that 2008 was just a warning. So I know we just put out a piece on the history and everything that led up to 2008 and then to where we are today. But Eric and I also did a piece, just a conversational piece, to help you understand that even better. So because it's critically important. Ignorance doesn't make you immune. It just leaves you vulnerable. And we're trying to create pieces that you can share with your friends and loved ones that maybe they will listen to and start to understand where we are. Because seriously, we're running out of time. And again, if you have not yet started your gold and silver strategy, click that Calendly link below and give us a call and set that time up. You've got to have wealth insurance, and that's exactly what gold is, and purchasing power insurance. And for me, that's what silver is. So if you like this, please give us a thumbs up. Make sure you leave us a comment. Make sure you subscribe. And really, I think this is a great one to share. Even if all you share on this one are the audios from that just recent FDIC meeting. Share, please. You know, this is just a big club, and you and I are not in it. But JP Morgan is certainly in it. And so let's look at the terms at which JP Morgan was able to acquire First Republic. I don't know. You think they got a pretty good deal? And is this the end of it? I mean, does this solve all the banking turmoil? And is JP Morgan so big and strong, and Bank of America and all those commercial banks that are also sitting on an awful lot of underwater debt? Did they solve all of this issue? I don't know. Let's look back on history to see what is the most likely outcome in the future. I mean, the future right now. And what kind of deal did JP Morgan get? Coming up. I'm Lynette Zang, Chief Market Analyst at ITM Trading, a full-service physical gold and dealer specializing in custom strategies. And I hope you have your strategy in place, and I hope you're actually executing it, because what's going on in the banking system should be an indication, and the treasury markets, frankly, should be an indication to you of how close we are to the end. So let's go back on memory lane a little bit to see really where we are. Because going back to 2008, at what point did the public recognize the crisis? Remember, I had David Dubine, actually, who I think is brilliant, ask me why I wasn't at the bug out house yet. That's because the public doesn't recognize what is unfolding. When they do, that's where you're going to find me. But going back to 2008, how many banks failed? because we kept telling we were being told that the crisis was contained. You know, same thing as we're being told now. But in July of 2008, that's when the bank failures really started. 3 banks failed. Oh my goodness, okay. In August, another 3 banks failed. Now, these weren't really large banks. A few of them were, IndyMac, etc. In September, 3 more banks failed. In October, 4 banks failed. And basically, this was right around the time when people started to recognize that we had a problem in the banking sector. So we've had 5 bank failures now. Where are we in this? When will the public really recognize? And it's been critically important to bail out all of depositors so that they're attempting to do a controlled demolition of the banking system. But all of this brings more and more consolidation. And that means that it consolidates the power and it also consolidates the risk. And the question is, when do you want to know? When do you want to be in position so that this kind of garbage and this next financial crisis doesn't become a crisis for you and your family? Now let's just dive into First Republic. $229.1 billion is the total value of assets held by First Republic as of April 13th. Okay, that is the total value. Let's see. This makes First Republic's collapse the 2nd largest bank failure in U.S. history. How much did JP Morgan pay to buy $229.1 billion in assets? Well, we now know the FDIC will cover 80% of any losses that are incurred. So all of that underwater, remember, interest rates, market value of bonds, right? So all of those underwater bonds, the FDIC will cover 80% of any losses. Now, if you listen to Janet Yellen, you don't want to say, well, taxpayers aren't going to cover this. The FDIC is going to cover this. And they're going to do it by special fees on the banks. Well, what do you think? They think the banks are in business for your benefit? Heck no. Ultimately, anybody that uses any of these banks are paying these fees. And oh, by the way, that's over the next 7 years. So they don't have to sell these off right now. The hope is that they will, that when the Fed lowers the interest rates, that they will recoup the principal. But hey, the FDIC is going to incur the losses over the next 7 years. JP Morgan Chase will also not assume any of First Republic's corporate debt. So FDIC will take care. Now remember, they only had, at the start of this debacle, not First Republic, but all the banks' failure, they only had $128 billion in their DIF fund. But hey, the FDIC will cover this. Where's that money coming from, really? And JP Morgan will receive $50 billion in financing at very good rates, I'm sure, from the FDIC to complete the deal. Okay, so the FDIC will cover 80 losses. The JP Morgan will not have to take on any of First Republic's corporate debt, and JP Morgan will receive $50 billion in financing. Chase will make a $10.6 billion payment to the FDIC. So they're getting $50 billion in financing, but they're going to pay $10.6 billion to the FDIC, and they're getting, what was that number? $229.1 billion in assets. Seems like a pretty sweet deal to me. What do you think? Well, let's just keep going. The return of the 25, remember all the 11 banks got in and gave First Republic $30 billion in deposits, and that was supposed to take care of it? Well, JP Morgan, out of that $50 billion, I guess, will return $25 billion in funds that the other banks deposited and eliminate the $5 billion that they had put up. Okay? And they will record a one-time gain of $2.6 billion on the books from the deal. But they're getting a much bigger gain than that, I'm thinking. The FDIC estimates its deposit insurance fund will take a $13 billion hit. Is that like ultimately after they've covered 80% of the losses and given Chase $50 billion in financing and they only got $10.6 billion back? You see what I'm saying here? Seems like a pretty sweet deal to me. No wonder they took it over. And JP Morgan, the largest bank in America, is now that much larger because they absorbed the second biggest bank failure in history. JP Morgan is definitely too big to fail. Little banks might not be, but it'll be when they are ready to let one go. So far, every single bank that's failed, the FDIC has deemed systemic. And we've bailed out venture capitalists, and we've bailed out tech companies, and we've bailed out the wealthy, but don't call it that. Yeah, well, arose by any other name. So look at what's happening in this smaller banking, in the regional banking community. What's happening is that the market does not like them, right? And traders are attacking the stock. There's Zions, Western Alliance, PacWest, and there was First Republic. Now they want to say that this is just a one-off, and this is a one-off, and that's a one-off, and the crisis is contained, and it's a one-off. Yeah. Does that look like an anomaly to you? Does that look like a one-off to you? Because it doesn't to me. And remember, this is all about trading. It's not about stability for the global economy. I know that's what they want you to believe, but they've chosen winners and losers, and you and I are not winners. That's why you got to become your own central bank. You've got to make it so that you are your own advocate, your own central bank, and your own. You have to be as independent and self-sufficient inside of this as possible, or you're going to be subject to the traders too, because everything has become a trading instrument. Now, part of what triggered it is they're considering a sale or breakup in business amid the stock drop. Well, if they're so solid, why would they have to do that? Because they're not really solid. But they are evaluating options such as raising capital, so what, issuing stock into that route, you saw what it looks like, or breaking up the business. So the system, the regional banking system, is definitely in deep trouble. The bank has recently experienced a decline in deposits. So these are runs, and you know what they're going to do. They're going to raise the deposit insurance level, even though they can't pay it at this level now. All right. And will you believe them? And is PacWest the next bank failure? Hey, they had 2 days where the stock went up, but yet it was still underwater, and today reversed that. They're just going to change the deposit insurance scheme. Just like, think about when that went into place. It went into place in 1933, along with Glass-Steagall, which separated deposit-taking banks from risk-taking banks, from Wall Street banks. Have you heard even one entity, the Treasury, the Fed, the FDIC, even the talking heads on TV, have you heard one person saying, gee, maybe we need to separate the deposit-taking banks, which are using your deposits as collateral for their trading, from the trading-taking banks? No, they are not talking about it. Nobody's talking about it because they're not going to do it. They don't want to do it. The banks make too much money on trading. Most of their profits come from trading. but also the risk that they heap on us. And keep in mind that it's these guys, these bigger guys, not the PacWest, not the regionals, but JP Morgan, Bank of America, all those guys that create these derivatives and then can say whether or not it's a default. It's really kind of interesting. It's the foxes watching the hen house determining whether or not after a chicken is killed, if one of the foxes killed the chicken or not. Who knows? But they are weighing more business deposit insurance after banks fail. Isn't that interesting? The FDIC announces several options for the deposit insurance fund. What are they? Because of, and they never take credit for creating the problem by ZIRP, zero interest rate policy, and all of this free money. God forbid that they ever look in the mirror and say, maybe we shouldn't do that. No. Because of Fed money printing, the proportion of uninsured deposits surged to 47%. That's all that free money in 2021. The highest level since 1949, which is when right around the time of the Bretton Woods Accord, that was a change in the monetary system, and the US dollar became the world reserve currency, and all currencies were pegged to the dollar. So we've got to pay attention to these dates, though nobody ever takes it to the next point. What was happening then? Oh, there was a shift in the system, right? Yeah, let's not do that. But here's what they're talking about. Limited coverage, the same as it is now, but higher, more coverage. They can't afford what they've got, but okay. Unlimited coverage for all depositors. So, hey, you can hold as much as you want, but who's going to pay for that? Are the banks really going to pay for that? No, darling. You and I are going to pay for it. And targeted coverage. Coverage dependent on account types. So businesses get more coverage because they've got to run payroll. They have to keep money in the bank for large expenses, etc. So they're talking about targeted coverage. So less for the individual depositors, more for the businesses. Who's really going to benefit from that? And it's all a scheme anyway. That's what they call it, a scheme. I don't call it a scheme. I call it a scheme because they do. And there's a problem because job gains and wages are signaling labor resilience. So honest to goodness, what does that mean for the Federal Reserve? Because they're afraid of a wage price spiral, right? So everything costs more, people ask for higher wages, and then things cost even more, etc. That's that wage price spiral. So what is the Fed likely to do? Have to keep raising rates, right? It is really pretty interesting. The U.S. economy registers solid job growth. That's this change in non-farm payrolls, right? Up a little bit. But look at the change in hourly wages. So this is the unemployment rate, matches the lowest since 1969. What was happening in 1969? Oh, we were transitioning from a gold-backed currency to a debt-based currency. So you see all of these dates, they're really interesting, and they are so telling because you always have to look at what was happening during that period of time. And then is that the same reason that this is happening now? Because at the same time that we have the unemployment rate at the lowest since 1969, so things are great. But the Fed wants higher unemployment so that employees don't have as much power in negotiating wages. Average hourly earnings post the strongest monthly advance in a year, putting pressure on the Fed. The Fed has to make a choice. Do they fight the inflation by raising the rates? Or do they lower the rates to deal with the banking crisis? You see, they're between a rock and a hard place, but either way, it doesn't really matter, does it? Right? If they continue to raise rates to fight the inflation that they caused, well, then you're going to see more and more cracks are going to become obvious. Right now we're seeing the tip of the iceberg, but most of it is underneath here. So as the water goes out, we're going to see more and more and more of this iceberg as they continue to raise rates. On the other side of it, what do they do when the economy starts to sputter and the banking system starts to implode and the treasuries start to implode? Well, it's pretty simple. They drop rates back down to zero and they start their money printing machine. That's what they do. So what are they going to do in this case? Well, time's going to tell. But, they raised them 1/4 point for their credibility, not because it really did very much one way or the other. And they're saying, oh, well, okay, so inflation is kind of cooling off, so we can maybe hold back on rates. Well, let's just see what happens. But in the meantime, what I know needs to happen is we all need to protect ourselves. And we know we've got silver. Citi analysts predict near perfect conditions for silver's ongoing bull market. Experts suggest $30 an ounce a possibility. Well, have you tried to buy a 1 ounce silver dollar? Because you're paying more than $30 for it. So is that even, they're talking about the spot market, where you can create as many silver contracts as you want that they don't have to have, and they don't have the actual physical silver underlying. Whether it's silver or it's gold, what you need to understand is it's a bargain. At this juncture, it is a bargain and so severely undervalued, it's ridiculous. So what are central banks doing? They're loading up. Don't you think you should too? You think they might know something that you don't know? You can see the resistance level over here at the beginning of 2023. You got a breakout, and guess what? You got another breakout. Now, is this pervasive? I don't know. We'll see. And $30 an ounce, you going to sell your silver when it gets to $30 an ounce? You can't replace the physical. You can replace the paper, but you can't replace the physical for $30 an ounce. And it's severely undervalued. It's time to execute your strategy, get it in place. Gold, silver, food, water, energy, security, barterability, wealth preservation, community, and shelter. Because really, severely undervalued, and so is gold. Central banks are buying it hand over fist. What do you think? You have this, it's out of the system, it's invisible, and it's a perfect, for me, silver is the perfect tool of barter in any form. I don't care, in any form. So if you haven't done so already, make sure you subscribe. Leave us a comment, give us a thumbs up, and check out our other channels. Beyond Gold and Silver, ITM